Wall Street, I mean, it's practically a synonym for like getting rich quick, right? You think about high frequency trading, IPOs, people making fortunes overnight.
Yeah, it's definitely got that image.
But what if I told you one of the most reliable ways to actually build wealth on Wall Street is way more about patience and consistency, and that it might involve a company that's been quietly delivering for investors for over 200 years.
You're definitely hitting on something. I mean, a truth even. While all that flashy stuff gets the headlines, building real lasting wealth, well, it usually comes from those steady dividend-paying stocks.
Yeah.
And we've actually got some pretty interesting data to back that up.
Okay, so let's break down dividends real quick for anyone listening who might be new to this whole thing.
Sure.
Dividends, those are the regular payouts companies make to their shareholders, right?
Oh, sorry.
I'll admit, it doesn't exactly sound as exciting as, a stock splitting overnight and doubling your money instantly.
I get that perception.
Yeah.
But this is where a study by Hartford funds gets really interesting. They looked at 50 years of stock performance. So from 1973 to 2023.
Wow, that's a long time.
It is. And what they found is that dividend-paying stocks, well, on average, they ended up giving investors an annual return of over 9%.
9%?
Over 9%, which is more than double the return you got from stocks that didn't pay dividends.
Wow. That's a huge difference.
Those averaged, just 4%.
So they're not only giving you some income,
Right.
They're also outperforming over the long term. I mean, that's pretty convincing.
I think so.
But as you said, I think the real challenge is finding those truly, high-quality dividend stocks.
Yeah, for sure.
Because, I mean, after all, any company could decide to start paying dividends one day and then the next.
Proof gone.
Exactly. Things go bad and they cut them off.
You got it.
Yeah.
Not all dividend payers are created equal, that's for sure. That's why you got to look for companies with a real track record.
Yeah.
A history of getting through different economic climates,
Making it through the tough times.
Exactly. Think about companies like Johnson & Johnson, the big healthcare company. I mean, they've increased their dividend for 62 years in a row.
62 years straight.
62 years.
That's wild.
Or think about Procter & Gamble, right? I mean, everyone knows their brands. Crest, Tide.
Oh, yeah. Those are in, every house.
Exactly. Those household names, they just provide such consistent cash flow no matter what's happening in the economy.
Right.
And they've been raising dividends for 68 years. These are companies that are built to last,
68 years. Okay, I'm starting to see why long-term investors are so into dividends.
It's pretty incredible.
But I'm guessing there are companies out there with even longer track records, right?
Oh, absolutely. There's actually a super elite group called the Dividend Kings.
Dividend kings, huh?
I know, right?
Yeah.
These are companies that have raised their dividends for at least 50 consecutive years.
50 years.
50 years straight. And then you've got companies like ExxonMobil and Stanley Black & Decker. Both of them have been paying dividends for over a century.
Okay, now you've really got me intrigued. Are you telling me there's actually a company out there that beats those streaks?
This is where things get really interesting. You ready for this?
I am. Hit me.
Let me introduce you to York Water. You probably haven't heard of them.
I don't think so, no.
It's a smaller water utility company. They operate in Pennsylvania. And get this, they've been paying consecutive dividends since 1816.
Wait, 1816? That's before Coca-Cola, right?
It is, even before Coke started.
I mean, that's got to be some kind of record.
It is. What's even wilder is that York Water isn't some huge corporation or anything.
Really?
It's actually relatively small. They serve about 300,000 people.
So how have they managed to pull that off? I mean, 200 years of uninterrupted dividends, that's incredible.
I know, it's pretty amazing. So let's start with their business model, right? I mean, their whole thing is providing water and wastewater service.
It's a pretty essential service.
Talk about a basic necessity. Demand for water is super stable, which means they've got predictable cash flow year after year, no matter what the economy is doing.
That makes sense. People always need water.
Always.
But I'm guessing there's more to their consistency than just providing water.
You're right. York Water also operates as what's called a regulated monopoly in their service area.
Okay.
So that means no competition.
Ah.
Okay. Which again makes that cash flow even more predictable.
So for our listener who might not be familiar, can we explain what a regulated monopoly is? I mean, it kind of sounds contradictory, right?
Of course.
Yeah.
Basically, it means that York Water is the only company allowed to provide water in their designated area. The government grants them that right, but it comes with a condition.
Okay.
Anytime they want to increase prices, they have to get it approved by regulators.
Interesting.
So they're not exposed to those crazy price swings you see in more competitive markets,
So it's kind of like a win-win, right?
Yeah, exactly.
They have a guaranteed market, steady revenue, but there's some oversight to make sure they're not taking advantage of that.
Exactly.
Yeah.
And this whole regulatory system is actually a huge part of why they're able to keep paying and growing their dividend. It's a big part of their success.
I can see that. So on top of that, how are they managing growth? I mean,
That's a great question because it's not like they can convince people to drink more water or something.
right. The market for water itself is pretty stable.
It is. So York Water has come up with a pretty clever way to expand. They make these strategic little acquisitions of other water systems in their area.
So they're kind of just adding on, like absorbing these smaller companies to grow their customer base
Yeah,
and
exactly.
their infrastructure.
Yeah.
It's kind of like a snowball effect, right?
Yeah, that's a great way to think about it. And they're very picky about it, too. They only go after acquisitions that make sense,
I see.
ones that fit in with their existing operations and actually boost their profits. They're not just growing for the sake of growing.
Right.
It's got to be sustainable growth that supports that whole dividend policy we were talking about.
Makes sense.
And that actually brings up another interesting point. Remember that whole regulated monopoly thing we were talking about?
I do.
Well, that's actually a huge part of how they're able to grow, too.
Now, that's interesting to me. How does being regulated help them grow? I mean, wouldn't it be harder, having to get approval for every single thing they do?
It's true that they can't just raise prices on a whim.
Right.
Every time they want to increase rates, it's got to be approved by the Pennsylvania Public Utility Commission,
Interesting.
which might sound kind of limiting at first.
It does.
But think about the upside for you as an investor.
Okay, I'm all ears.
It protects them from the craziness of wholesale prices. They don't have to deal with those crazy price swings that a company buying and selling out on the open market would.
Oh, I see. So they have stable costs.
Exactly. And that steady revenue means they can actually plan for the future with confidence and make those smart acquisitions we were talking about.
So it's a trade-off, really. They give up some flexibility in pricing but get stability and predictability in return,
That's it.
which in the long run makes them a much more reliable investment. I'm starting to see why this company has been so successful, They provide a service everyone needs, water.
Exactly.
They operate in this really stable regulatory environment, and they're growing in this smart, strategic way. It's a really powerful combo.
It really is. And you can see that reflected in their performance. Remember those numbers we talked about earlier?
Uh-huh.
Their total return since 2000 is almost 1,000%.
Ooh.
Way more than the S&P 500. And their dividend yield, while it's not the highest out there, it's super solid and keeps on growing. It's not just talk with them. They actually back it up.
I mean, it really makes you rethink that whole don't put all your eggs in one basket thing,
Mm-hmm.
We hear it all the time about diversification, but York Water seems like a pretty darn good basket to put some eggs in.
Right. It really raises an interesting question for investors. How much should a company like York Water actually make up in a portfolio? Especially when you see how well they've consistently performed.
It's almost like they're defying the rules. But before we get too carried away here, let's talk about the big thing everyone's thinking. Valuation. Some people see that stock price and think, whoa, that's expensive.
Right.
What would you say to that?
It's a valid concern for sure. I mean, their price to earnings ratio, that PE ratio, is higher than the average for the market overall. But it's important to really get what that means,
Yeah.
York Water, it's not your typical high growth stock. It's not going to suddenly double its revenue overnight or anything.
Right. It's slow and steady.
Exactly.
Yeah.
Can we quickly explain what that PE ratio means, for folks who might not be familiar with all the financial jargon?
Definitely.
Okay. So the PE ratio, it basically tells you how much investors are willing to pay for every dollar of earnings the company makes.
Okay.
So sometimes a higher PE ratio can mean a stock is overvalued.
I see.
But with York Water, it actually represents something different.
Interesting.
It shows that investors are willing to pay a premium for that stability and consistency we've been talking about.
Because, people are always going to need water.
Right, sure.
So even if their growth isn't super flashy, it's dependable.
Exactly. And if you actually look at their PE ratio over time, it's kind of low right now.
Really?
Yeah, which suggests that even though they're doing well, they might actually be undervalued by the market.
So if you buy their stock now, you're essentially getting a deal.
Potentially, yeah.
Yeah.
It's kind of like getting in before the price really takes off.
It sounds almost too good to be true. Are there any downsides or risks, though, that investors should know about?
That's a great question. And, it's always important to consider the potential downsides, even for a company as solid as York Water. While that whole regulated monopoly thing is a big benefit,
Yeah.
any changes in regulations could definitely have an impact. And like with any company, there's always the risk of something unexpected happening.
Mm-hmm.
Some event or a management change that could affect how well they do.
So as impressive as their track record is,
It's not a guarantee.
right, due diligence is still key.
Absolutely. And that kind of brings up a bigger question. How much weight should we actually put on past performance when we're looking at a company? I mean, is it really a sign of future returns, or are there other things that could change their success?
Yeah, that's a great question.
It's a question for the ages, right? And I think it's a perfect way to jump into the next part of our deep dive.
Let's do it. I'm ready. So, we've spent all this time talking about York Water and their crazy 200-year history of dividends.
Yeah.
But it's got me thinking, we've focused a lot on their past. What about the future? What are their chances of keeping up this growth, especially with everything changing so fast these days?
That's the million-dollar question, isn't it? Any investor wants to know that. And while no one can predict the future for sure, there are definitely some promising signs for York Water going forward. One big thing to think about is that all this talk about increasing infrastructure spending here in the U.S.
Yeah, it's everywhere in the news lately.
Right. And, well, that could have a big impact on a company like York Water.
How so?
Think about it. As the country puts money into fixing up those old water systems, companies like York Water, they've got the know-how and the infrastructure already in place.
They're ready to go.
Exactly. So they're really well positioned to benefit from that spending. They can get contracts for these huge projects, which could mean some serious growth opportunities for them.
Makes sense. It's not just about keeping up what they have now, but also growing and modernizing along with everything else.
Exactly. And as they expand and upgrade their systems,
Yeah.
well, it could make them even more efficient and profitable,
Right.
which, of course, would just help them increase those dividends even more down the line. And that's what we as dividend investors love to see, right?
Definitely. So even though they're not a massive company right now, that they have the potential to play a big role in this whole national project.
They do.
That's pretty cool. But kind of switching gears a bit,
Sure.
for anyone listening who's really intrigued by York Water, maybe thinking about adding them to their portfolio,
Yeah.
what's the most important thing to keep in mind?
That is a great question. I think it all comes down to really understanding their business model, their long-term strategy.
Right.
Remember, York Water isn't about that explosive, get-rich-quick kind of growth.
Right.
They're in it for the long haul.
It's slow and steady wins the race.
Exactly. They're focused on that consistent performance, keeping those dividends coming, and just building value over time. It's about having that long-term mindset.
Yeah. It's almost like a whole different way of thinking about investing, isn't it? Like you're buying a piece of a company that's been around for centuries.
Right.
That provides something everyone needs, water.
Yep.
And that has this proven track record of getting through all kinds of tough times,
Absolutely. I mean, York Water really flips the script on what we usually think makes a good investment.
Yeah.
It reminds us that sometimes the best way to invest, well, it's not about chasing those hot new trends or trying to perfectly time the market.
Right.
Sometimes it's about finding those companies that are under the radar, quietly getting it done year after year.
Like York Water, this small water utility that's been taking care of its shareholders for over 200 years.
It's pretty remarkable.
And hey, maybe their story will inspire some of our listeners to think a little differently,
I hope so.
To look past the headlines and find those hidden gems for themselves.
It's a big world out there, full of investing possibilities.
Definitely. Well, thanks for joining us on this deep dive into York Water and the whole world of dividend investing.
My pleasure. I always enjoy talking about this stuff.
We'll be back next time with another fascinating story from the world of finance and investing, so be sure to tune in.